Everyone calls The Intelligent Investor the Bible of investing. Warren Buffett says it's the best investing book ever written. But here's the truth. The book was written in 1949. That's before index funds, before crypto, before Robinhood apps that make buying stocks feel like swiping on Tinder. Don't get me wrong. The book is a masterpiece. But there are critical lessons you won't find inside those pages that you need to survive in today's investing world. In this video, I'm going to share 8 powerful lessons Graham didn't cover, and lesson number 8 might just save your financial future. Stick around to the end, because I'll also share how you can actually use these lessons to invest smarter today. Lesson 1. Behavioral finance matters more than you think. Graham warned us about Mr. Market and emotions, but he didn't dive deep into psychology. Modern research shows we're terrible with money. We panic sell, we chase hype, and we fall for FOMO faster than we fall for Netflix recommendations. Meme stocks in 2021. People were buying because a stranger with a cat profile picture on Reddit said, "Hold the line." Today, mastering your behavior is just as important as mastering your balance sheet. Your portfolio might be in the green, but if your brain is in the red, you're in trouble. Lesson 2. Index funds beat most stock pickers. Graham believed in picking undervalued stocks. But today we have index funds. John Bogle's invention is like the cheat code for investing. 80 to 90% of active managers underperform the market long term. If you want to beat 90% of people, don't pick stocks, just pick an index. Index funds are like a boring relationship, not flashy, not exciting, but you wake up 30 years later rich and happy. And honestly, that's a dream. Lesson 3. The role of technology in investing. In Graham's time, you called your broker on a rotary phone. Today, you can buy Dogecoin at 3 a.m. while brushing your teeth. Technology makes investing easier, but also more dangerous, because it feels like a video game. Studies show the more often you check your portfolio, the worse your returns. Discipline today means resisting the urge to click buy every time a stock trends on Twitter. Your investing app shouldn't give you dopamine hits like Candy Crush. If it does, delete it. Lesson 4. Globalization and diversification. Graham focused mainly on U.S. stocks. Today, you can own companies in China, India, or Brazil with a single ETF. Don't ignore global growth. The world isn't just the S&P 500. If your whole portfolio is U.S. tech stocks, congrats! You basically work at Google without the free snacks. Lesson 5. Inflation and alternative assets. Graham worried about recessions, but today we got inflation on steroids. Alternative assets like real estate, REITs, gold, even Bitcoin are part of many investors' portfolios now. The intelligent investor didn't prepare you for meme coins or avocado toast costing $15. If Graham saw Dogecoin, he'd probably say, "This is not intelligent investing. This is a dog with a calculator." Lesson 6. Taxes and retirement accounts. Graham never wrote about 401k, IRAs, TFSAs, or Roths. They didn't exist yet. Today, taxes can eat your gains faster than inflation. Smart investing isn't just about picking winners. It's about keeping more of what you earn. The government always wants a slice of your pie. Retirement accounts are basically a way to say, "Back off, IRS, this slice is mine." Lesson 7. FIRE and lifestyle investing. Graham wanted you to beat inflation and stay safe. But modern investors want more. Financial independence, freedom, retiring early. The FIRE movement is about designing life first, investing second. Imagine telling Graham, "I'm retiring at 35 by living off dividends." He'd probably adjust his glasses and say, "That's not intelligent. That's witchcraft." Lesson 8. ESG and impact investing. ESG stands for environmental, social, and governance, and impact investing is about putting your money into companies that do good for the world while making money, like renewable energy, ethical tech, or sustainable agriculture. Graham didn't cover this. His book focused purely on numbers and undervalued stocks, not values or social impact. But today, many investors care about aligning their money with their principles, and ESG funds are attracting billions every year. You can combine Graham's principles, margin of safety and long-term thinking, with ESG investing. In other words, you can grow wealth while supporting companies making a positive impact. So, what have we learned? The intelligent investor taught us timeless truths, margin of safety, patience, and long-term discipline. But the modern investing world also demands lessons Graham never covered, from behavioral finance to tech-driven investing and aligning your money with your values. You don't have to choose between old wisdom and new lessons. You get to combine them. Think of investing like driving a car. Graham gave us the rules of the road. Stay in your lane, don't speed, wear a seatbelt. But today, we're driving Teslas on highways Graham never imagined. The rules still matter, but you need to adapt to the vehicle and the road you're on. If you do, you won't just be an intelligent investor. You'll be a modern investor, one who can build wealth, protect it, and actually enjoy life along the way.